Did you know that individual investors lose an estimated $50 billion every year chasing short-term speculation? That staggering number is the graveyard of financial mistakes. Now, what if the greatest investor in history, Warren Buffett, could hand you the cheat sheet to avoid that graveyard? We all obsess over what the Oracle of Omaha is buying. But the true key to his multi-billion-dollar success lies in what he never touches. In this video, we'll break down the 3 fundamental things Warren Buffett refuses to invest in and why his avoidance is your golden rule.
The first thing Buffett avoids is anything that falls outside his circle of competence. He famously said, "Risk comes from not knowing what you're doing." He doesn't invest in businesses he can't fundamentally understand. Think bleeding-edge biotech, complex algorithms, or highly speculative tech startups. If he can't clearly define how the company makes money, he walks away. He's not looking for the next miracle stock. He's looking for enduring, simple value. This is why his portfolio is filled with straightforward businesses like Coca-Cola or insurance firms. Before we dive into Buffett's second forbidden asset, if you're serious about building wealth the smart way, hit that subscribe button right now. Your long-term portfolio will thank you. Secondly, Buffett has a profound disdain for what he calls non-productive assets. The 2 main targets here? Gold and cryptocurrencies. His reasoning is brutally simple. They don't do anything. A farm produces crops. A company produces earnings. An apartment building produces rent. Gold and Bitcoin? They just sit there. Their entire value is dependent on someone else being willing to pay more for them later. He views them as speculative bets, not investments. In his words, he'd rather own a 1,000-acre farm that produces grain than a non-productive golden egg. He wants assets that generate cash flow, not just hopeful admiration. Finally, Buffett refuses to engage in short-term gambling. Strategies like short selling, complex options trading, or trying to time the market. For Buffett, buying a stock is buying a piece of a business he holds for decades. Speculation, the act of predicting what the stock price will do in the next 6 months, is completely against his philosophy. He's focused on the intrinsic value of the company over the next 20 years. He's an investor, not a gambler. His entire strategy is built on patience and the power of compounding, a magic that short-term trading actively destroys.
So there you have it, the 3 golden rules of what Warren Buffett avoids. Assets you don't understand, assets that don't produce cash flow, and the lure of short-term speculation. Which of these 3 don'ts is the hardest for you to follow? Let us know in the comments below. If you truly want to emulate the Oracle of Omaha, stop focusing solely on his buy list. Start by rigorously applying his avoid list. That decision alone could save you billions in potential mistakes.